Every insight deserves an audience. Welcome to Atypica AI.
Bitcoin just hit $86,000, down 37% from its October peak of $126,000. Your portfolio is bleeding. Twitter is full of "told you so" posts, and everyone's asking the same question: how much lower can this go? Here's what I discovered after diving deep into the data. This isn't the crash everyone fears. It's actually the most predictable correction we've seen, and the signals are screaming that we're approaching the bottom. Let me show you exactly why. I know you're probably thinking, another crypto expert claiming they can predict the market. But here's the thing. I'm not trying to predict anything. I'm reading what the data is already telling us, and it's painting a very clear picture that most people are completely missing. Let's start with what's actually happening. This 37% drop looks terrifying, but put it in context. Bitcoin's previous bear markets saw 70 to 84% crashes. The 2018 collapse, down 84%. The 2022 FTX disaster, down 77%. What we're seeing now is what I call a mid-cycle correction, the kind of healthy pullback that happens even in the strongest bull markets. The catalysts driving this decline are entirely external. The Federal Reserve pivoted hawkish after inflation came in hot at 3% instead of the expected 2.8%. Rate cut odds plummeted from 93% to 38%. Japan raised rates to a 30-year high, unwinding yen carry trades that historically tank Bitcoin by 20 to 31%. These are macro headwinds, not Bitcoin-specific problems. But here's where it gets interesting. While everyone's panicking about the price, the underlying fundamentals are screaming the opposite message. Let me walk you through the 3 key indicators that convinced me we're near the bottom. First, whale behavior. While retail investors are capitulating, whales are accumulating aggressively. In just 10 days, large holders added 75,000 Bitcoin to their stacks. We're seeing 102,000 transactions above $100,000, the highest peak of 2025. When smart money is buying this heavily during a crash, that's not coincidence. Second, exchange reserves hit a 7-year low at just 2.44 million Bitcoin. Think about what this means. Despite massive selling pressure, more Bitcoin is leaving exchanges than entering. People aren't dumping, they're holding. This is the exact opposite of what you'd see in a real crash. And third, and this is crucial, short-term holders are 99% underwater. This exceeds even the FTX collapse levels. When capitulation reaches this extreme, it signals exhaustion. There's simply no one left to sell. You might ask, but what about those massive ETF outflows? Yes, November saw a record $3.79 billion in outflows, with BlackRock's IBIT losing $523 million in a single day. But here's what the headlines missed. These ETFs still hold $120 to $150 billion in assets. A few bad weeks doesn't erase the structural shift toward institutional adoption. I anticipate your next question. If this is just a correction, why does it feel so much worse? Because we're in a new era. Bitcoin ETFs mean traditional finance volatility now directly impacts crypto. When the S&P 500 correlation hits 0.9, Bitcoin moves with macro fear, not just crypto fundamentals. Looking at the technical picture, we're approaching critical support at $80,000 to $85,000. This level represents multiple confluences: the 61.8% Fibonacci retracement, the 20-day moving average, and massive whale accumulation zone.
If this holds, and the on-chain data suggests it will, we should see a relief rally to $90,000 to $110,000 by Q1 2026. The timeline is becoming clear. The Federal Reserve ends quantitative tightening in December. Corporate treasuries are still adding Bitcoin. Arizona pension funds, El Salvador adding $100 million more. Regulatory clarity is improving with new legislation. All the structural tailwinds that drove Bitcoin to $126,000 are still intact. Here's what I'm doing based on this research. I'm dollar cost averaging into this $80,000 to $85,000 zone. Not going all in, not using leverage, but systematically adding to positions. The data shows this is likely the last time we'll see these levels before the next major rally. You're witnessing the maturation of Bitcoin from a speculative asset to institutional infrastructure. The days of 70 to 80% crashes are behind us because too much institutional money now provides a floor. This correction, painful as it feels, is exactly what healthy bull markets do. They shake out weak hands before the next leg up. Don't let the fear and headlines fool you. The smart money is accumulating while everyone else is capitulating. The question isn't whether Bitcoin will recover, it's whether you'll position yourself before it does.
Want to learn more about interesting research? Check out Atypica AI.